Production from the Canadian oil sands is set to hit a new record high of 3.5 million barrels a day this year and top 3.9 million by the end of the decade, according to S&P Global Commodity Insights. Let's get more from Kevin Birn, Chief Canadian Oil Analyst. Kevin, great to have you join us. We're looking at the chart. Spectacular growth. This is a 20-year chart, but since the beginning of the century, it's just been a huge growth story.
That's right. It's going to, and our outlook is it's going to continue to grow, maybe 500,000 barrels, as you talked about, by 2030. And most of that growth coming from optimization. So existing installed capacity operators are looking at ways to produce more from what they have.
That's interesting. So they don't even have to build giant new facilities. They can just get rid of bottlenecks and just squeeze more oil out.
Yeah, we've seen a focus on operational efficiency really since the end of the development boom. We, in and around 2017, 2018. Obviously, we had the price effects in 2018 and then the COVID effect in 2020. But we've seen this ongoing focus on optimization, using the facilities they have either to reduce downtime or increase throughput and putting more units out the door with the existing infrastructure in place.
Let's have a look at that chart again, because it does show what you call a softening in production post 2030. You're saying, though, it's nuanced. Part of that is a change in the nature of oil sands production?
Well, one is, our growth curve today is really based on these optimizations, and you use the word debottleneckings as well as in there. And one of the challenges in forecasting those types of things is they come from learning by doing. And so the foresight we have is more limited because the operators themselves are figuring this out as they go through the process of optimizing their facility. They turn a light bulb here, they turn a wrench there, and it becomes harder for us to anticipate that. So the other factor, that factor plays into the fact that this outlook is an upward revision, the fourth year in a row after many years of downward revisions. So we added about 100,000 barrels per day more expectation by 2030. And that's a result as we move through time, more discovery and optimizations. We don't think that continues forever. There is, for some of these facilities, they're going to get quite long in the tooth around 2030s. And so we do see the potential for some of the smaller facilities to start running into some more issues as a whole, barring those ongoing optimizations or moving into additional acreage. And the other thing that's not in our outlook is new facilities entirely, and these things could all buoy that to the upside. The other factor is we do see after 2030 potential for some of the bitumen, so from the thermal operations making their way into upgraders. And when you process bitumen through an upgrader and produce a synthetic crude oil, which is a light premium crude oil, you actually get a volumetric loss in some instances. And so that plays out in that outlook in the latter years as well.
That's interesting. So the volumes of upgraded products are obviously more valuable per barrel, but less volume. So we shouldn't run away then with you're not predicting that, it's going to peak in 2030 and then decline thereafter. That would be a simplistic takeaway.
That's right. And the best way to think about it, you begin to see the potential for a plateau. There is, potential upside, more optimizations than we currently anticipate that through discovery. And if you see additional egress that I think governments in Canada are talking about, you could see more development money potentially come in, and that outlook could be further higher and further out before you reach that plateau.
It's interesting, the old question of pipeline capacity. You think that problem has not gone away, even with Trans Mountain pipeline expansion apparently narrowing the discount?
Yeah, we have seen the discount remain fairly stable and narrow, and we are also seeing what we think is pretty strong demand for heavy oil globally, and that's causing the narrowing of differentials. But we do see with this outlook and others, ongoing production increases we expect from the oil sands will mean more volume has to leave Western Canada. And without in the absence of additional optimizations coming online, so if you hold the system flat, we do think that the system could be under pressure by late 2026. And so that is something to look forward to continue to look at. The egress issues, certainly Trans Mountain has bought the industry time and some breathing room, but with continued growth, there will be the need for incremental optimizations of existing pipelines or even new pipelines in the near future.
Right. So by the end of 2026, so that's, it takes so long to build pipelines and get approval for them. So that could turn into something of a problem, an egress problem.
We don't think it'll materially be a problem in 26. We've seen, in the past, Western Canada would butt up against its export capacity, typically in the winter months, and that'd cause weaker differentials, and the industry would store through those periods. I think, the prospect of the end of 26, you could start to see the beginning of that situation. We're not sure it'll emerge in wider differentials quite then, but the pressure will begin to be seen on the system as a whole. And then, as you know, the Western Canadian system works in cycles. So your peak production is typically December, January, February, when the coldest months, and the facilities try to run the hardest to combat that temperature, and then ease off and we move into that turnaround season. So that pressure in the cyclical nature, as you see production growth in the chart I'm showing you is annual production additions, that pressure will build through 26 and into the winter season of 27.
I'm just thinking, obviously, it's such a complex system. A good chunk of the country's natural gas is used with SAGD to soften up the bitumen so it'll flow. So presumably, if we did see a significant rise in natural gas prices, that would be a problem for the oil sands.
There is a symbiotic relationship that goes into the cost structure of the oil sands. Certainly, gas is a major feedstock, important ingredient into their costs. So higher gas prices would put upward pressure on oil sands break-evens. We do estimate oil sands break-evens, and I'm going to talk about what we talk about as half-cycle costs, so not just operating cost. For an oil sands producer, they often have to transport their product to market where it competes, which is typically in the Gulf Coast region. So there's the cost of transport, and for oil sands facilities that market diluted bitumen, they have to acquire the diluent and ship it to market with the bitumen as a whole. So our half-cycle cost in oil sands, we see somewhere between about $17 to $45 on a WTI equivalent basis. So we can think about it in terms of WTI. So certainly higher gas prices would put upward pressure, but we don't see it being a detriment to the overall economics of the oil sands. And typically, oil and gas prices still do move in relative step together.
Yes.
So the lower prices we're seeing this year for last year is putting downward pressure on gas prices, but we're also seeing that impact on exchange rate. We got to remember Canadian oil sands producers sell their barrels in US dollars and pay some of their costs in Canadian dollars. So there's a natural cushioning in a lower price environment that aids the producer, and higher price environment, you see escalation of cost as well.
And so, you said that the break-even, there's a range of 18 to 45, but as a kind of rough and dirty, an average break-even of about $27 WTI this year.
Yeah, that's the weighted average of of the different sources of supply and the range of costs we do see. Yes.